That's the main reason I did it. Yes?
Randy, I know this sounds like a plan, but it's really not. It's not a planted question. When you and I talked about something that was very impressive about the Black Swan,
Yeah.
and it's the trader nightmare or dream come true. Tell them what you told me about the Black Swan. It was great. It was a great explanation.
Yeah, I probably made something up. I'm joking. That's funny. So if you think about, we talked about this yesterday, and when you talk about your risk profiles, a Black Swan event, if something truly in the middle of the day did drop 50% or something to that level, well, we're going to eat that. That part we are. What we're not going to eat, though, is the likelihood of if it goes to zero, then it doesn't really matter anymore. Yeah, and oftentimes, more likely than not, the reality of the situation is it's like a rubber band when it's that fast in a single day. It bounces right back. Our AI will walk through some of those things. Kelly might have. Kelly.
Yeah, I'll expatiate a little bit on that one. Does anybody remember the flash crash? Maybe 2012, 10, 12. Remember there was a time, I remember it. I remember what happened. The market, all of a sudden, before anybody knew it, was down like 1,000 points within half hour.
2010.
What year?
10.
Yeah, I think it was 2010. And it was down 1,000 points. And then, of course, it recovered maybe 600 points pretty quickly right after that. But what causes a Black Swan event is pretty obvious. It was, in that case, a fat finger. Does anybody know what a fat finger is? Okay. So when that fat finger occurred, that was the thing that caused the market to induce selling. So one portfolio sells, and then including our software, if it was written a different way, would also have sold. And it keeps selling because numbers get triggered and then the market continues to go down and down and down. Everybody looks up and they have no idea what happened. So why is the market down 1,000 points? It was just flat. So in our software, because it's for essentially a retail client, no way to really step aside from that. You just can't. Otherwise, in the danger of it for a company like ours and to all of you is something called a stop. So if I have a stop in the market, it gets triggered. Market goes through my stop. First, I have a chance of getting a very bad fill, much lower than where the market might have been at the time it was triggered. And second of all, if it ever rebounds, I'm now out of the market completely and the market is already recovered. So the idea of using these short-term algorithms and things like that, they would be triggered. I wrote programs that would actually trigger just like that. The problem is if you do that, you trade very small. You trade a lot of different ideas very small. And that way they all get triggered over succession. Sometimes though, it will miss some of them, which means you'll have less and less risk. You don't take all your position off whenever you get stopped out. So what we do, of course, is we trade literally at the beginning of every day. There's a reason for that. There's two times in the day the market is liquid. The open and the close. You should really stick to trading when the market has liquidity. When all information is assessed, then you can trade. In the middle of the day, there could be all kinds of noise. Most of the time, there's not a lot of noise, but there will be things like that. So I have found historically, if you try to stop yourself out on things like that, you will invariably lose money. It doesn't work. There will be some times that it works out a good idea because the market will continue to go lower. However, in general, the better way to manage a Black Swan event, fat finger, whatever it is to let the dust settle for the day. Remember, even if that's the case, 1,000 points on the Dow, especially even back then, what that was is about 7%. All of us can manage a 7% loss. God forbid it happens, but we don't want to have 15% losses or 20% losses or 30% losses. It is far more easy if I was a manager to be able to explain to you, hey, this is what happened on that day. The truck would hit the thing on the George Washington Bridge, the bridge set on fire, and then all of a sudden there's a calamity in the world. And that's something I can explain. What I can't explain to people is why did you continue to stay in the market over a long period of time and the market just keeps going down. Eventually, all of you would come to me and say, what are you doing? Why? The market's going down and I'm still in it. That's the difference. So Black Swan events can be managed.
And come to him, not me.
Yeah. But at the end of the day, you have to let them play out.